technological upgradation. They are entering into new areas, offering very multivariate products to customers. The number of NBFCs is also growing at a very good scale. Currently, we have 9,000 more than 9,000 NBFCs which are registered, and this number is gradually increasing over a period of time. Over the last decade, we have seen a significant growth in the NBFC sector. From being around 12%, they are of the total balance sheet size of banks, they are now at a higher significant size. As per the recent report, in terms of credit growth, NBFCs have gone as high as 23% of the total credit of the country vis-a-vis the banks. So that also shows the important role that they are playing. So we can say both NBFCs are like big and small brother, while banks are the big brothers and NBFCs are the small brothers. So they go into areas or play a role where and banks are not able to reach. So banks, as opposed to banks, NBFCs have always enjoyed regulatory arbitrage, which have helped them to actually expand better with more sectoral and geographical expertise, expansion in terms of geography, technology, nature of products, services. All of them is something which NBFCs have been doing and growing over a period of time as opposed to a bank. The ease with NBFC which can give credit is also made possible by the technological advancement that our country has seen over the period of last 3-4 years. With the help of fintech, which has come of age, now NBFCs have wide range of tools in form of app, in form of easy KYC, in form of quick distribution of loan, credit analysis. So all of them and help them in along with banks to reach to a wider audience and to do a larger business as they were doing. While the number of lending apps have also been grown in the last couple of years. We have also seen a lot of illegal apps which are there in the market, with RBI taking stringent actions from time to time, government banning these apps. Recently also, Government of India banned certain apps which they thought were not performing due in accordance with the process of the law. I was reading today some of the apps which the government banned were actually in due compliance of law, and Ministry of Electronic Information Technology have already given instructions to Google and other app providers to restore these apps. But nonetheless, with this story or chapter of all these loan apps, prompted RBI to come up with a detailed guidelines also on how these digital lending apps will work and to some extent regulate these. So this is also something which we will be discussing over a period of time today, apart from the SBR regulations and other recent changes. So we have today two strong personalities with us to discuss this important topic. We have with us Mr. Shan, who is the Company Secretary and Compliance Officer at Hinduja Leland Finance Limited. He has been a professional with over 20 years of experience in leading major areas of highly matrixed legal compliance, governance, intellectual property domain, including and not limited to the NBFC domain. He has been expertise in drafting of agreements, contract negotiation, and a whole lot of areas. So we look forward to share the benefit of his knowledge during this webinar. Then we have Ms. Debashri Das. She's been recent recruited corporate professionals, has more than 9 years of experience of specifically working in NBFC domain, have worked in past with both investment credit companies, microfinance, and a whole lot of companies have handled compliance and regulatory domain there. So we look forward to receive their wisdom on the topic that we will be going to discuss today. So how the program is structured, Debashri Das will be sharing a presentation on the recent updates and developments that are there in the NBFC domain. Along with, we have Mr. Shan. I would be taking his inputs during the course of presentation, and will also have his inputs once the presentation is concluded to get an understanding of how this regulatory framework is evolving over a period of time. Post that, we will take your queries. We have already received some queries. You can also post your queries during the chat box, and we'll try to take all of them as far as possible. If anyone which remains unreplied, we will be coming back with their replies to them on their emails. If they don't receive their replies back, they can certainly reach out to us, and we'll make sure that we reply them on time. So now I'm handing over to the presentation to now Debashri Dash. I'll request Debashri, if you can just unmute your mic and start over with the presentation. I'll keep you involving Shan and during the course of the presentation.
Yeah, good evening to all.
Yes, Debashri, it's up to now.
Good evening, sir. Good evening, everyone present at the webinar. Welcome you all once again. Mr. Ankit gave a very apt introduction about the NBFC space and how it is gradually evolving, specifically in the current times. Of course, NBFCs have been in existence since decades. And it would not be wrong to say that the current phase is the most dynamic phase which the NBFC space is currently witnessing. And as mentioned by him earlier, maybe not long ago, just 10 years back, probably NBFCs were somewhere around 12% of the asset size of a bank. And now they have grown to almost 25% of the asset size compared to a bank. So sooner or later, somewhere, probably NBFCs, I mean, of course, there are few NBFCs who are such huge in their operations and size that they are almost similar to banks. And if we talk about the journey of how the regulatory framework of the NBFCs had progressed ever since. So it was in 1964 when RBI got the supervisory powers over the NBFCs. And since then, there have been 2 or 3 major we can say landmark years, which can be seen in the history in terms of the major regulations or wave of regulations that came in for NBFCs. It was in 98 when the NBFCs were categorized into deposit taking, non-deposit taking. And the scope of the deposits was clarified back then. And the scope of the auditor certificate was also widened. Then gradually in 2006, when we stepped in, the regulatory framework for the systemically important NBFCs were put in place. Then gradually in 2014, as we moved on, of course, there were, if you talk about the MFI space, there was a major crisis, as we all know. People who are in the microfinance industry would know that the Malegaon committee report was also came in, which came in, ushered in a new set of regulations for the MFIs. But apart from that, in 2014, again, the deposit acceptance requirements were harmonized across all the NBFCs. Then the threshold for systemically important NBFCs, that was also increased from 100 crores to 500 crores, given that the NBFCs were expanding at a humongous rate. And RBI felt the need to increase the threshold and include those additional NBFCs as well into the ambit of the additional regulations. Then constitution of different board committees also came into place. Of course, they were before as well, but they were clearly much more clearly defined. Then the rotation of audit partners every 3 years for systemically important NBFCs, those regulations also kicked in. And so ever since, after that, probably this year, 2022 can be said to be another major landmark in terms of regulations for NBFCs, wherein the scale-based regulation, as we all know, has been introduced. So somewhere the NBFCs, the regulations that were governing the NBFCs have always been lighter compared to a bank. Although the activities, as we all know, the difference between activities of a bank and an NBFC, but the NBFCs have in general been light on the regulatory part, reason being because so that they could cater to the very purpose of their existence. I mean, and the existence, as we all know, I mean, apart from providing last mile credit to the to the industries, to the people in general, to the grassroots level people, NBFCs, we can say, are the best alternative to the banks as on date. And they are the forerunners or the torch bearers when it comes to financial inclusion. And that is precisely the reason why we can say that the regulatory framework for NBFCs have never been kept so much stringent so as to not allow them to perform for which they are existing. But somewhere during the past, as we all know, the certain major cases have come up. Few major NBFCs, they in fact racked the entire market. It did not just affect one NBFC, the NBFC in question, but it had a ripple effect to the extent that it triggered NPAs across the industry, and it definitely was a call to increase the risk, to look at the risk perception that these NBFCs face. And so accordingly, the SBR framework, way back in 2021 January, the working report was published, and it had a lot of recommendations and reasons as to why a new framework, which is a scale-based framework, should be put in place. So maybe I'll just start off with the PPT, and we can have a look at the regulations in detail. If you can just allow me 1 minute. Is my screen visible?
Yes, it is. You have to put that on a slideshow. Yes, perfect.
Okay. So today we'll be, of course, since as you all know, there are, when it comes to NBFCs, the types of NBFCs are huge, more than 10, 12, 15 types of NBFCs we have. But investment and credit companies forming almost more than 90% of the total NBFCs that are registered with RBI. So today's focus will be on the investment and credit companies. The SBR regulations applicable on the investment and credit companies. Again, reiterating, the purpose for which the SBR was introduced was, one, the activities, as stated earlier by Mr. Ankit aptly, that the activities, the interconnectedness with the financial sector, the fintechs coming into play, the complexity of the transactions are increasing day by day. And that is one of the reasons why, along with the increasing complexity, the diversity of the risk also that the NBFCs are facing, that is also increasing day by day. And that is where the need was felt to of the risk that they are facing. Of course, risk management committees and other parameters to assess risk were already in place. But with the scale-based regulation, it aims to classify the NBFCs more so from a risk perspective rather than the size perspective. Of course, size is one of the major factors which has been used to classify the NBFCs under the SBR. So one or two key main points that we can say is, one, the diversification of the activities has resulted in the SBR, the increased risk exposure that the NBFCs are facing. Then the demarcation, as it happened, as I stated in couple of years ago, almost 10 years ago, the limit of systemically important NBFCs was increased from 100 to 500. Now, with the somewhere the government, the RBI wants to blur the lines between the non-SI and the SI, and that is why now the base layer is coming. All these the threshold has increased from 500 to 1,000 crores, and we will see that in the subsequent slides of how these NBFCs are now classified under separate layers. Also, another reason of the premise of introducing the SBR has been that there are certain NBFCs which are large in number, very huge in their operation size and activity size, that they are almost as good as banks. So somewhere there is a need to not make them as stringent as banks, but to bring them at par with banks just in terms of the risk perception. And also there are few NBFCs which do not need which do not need so much regulations. So the SBR also aims to reduce the regulatory framework of certain NBFCs, like the NBFCs which do not have public interface. They are exposed to very less regulations as compared to the existing guidelines, to the earlier guidelines. So to sum up, asset size, activity, the risk, and the I can say the discretion of the RBI. These are the four main factors which would determine how different NBFCs are placed in different layers. Asset size, of course, as I stated earlier, earlier we had this bifurcation of systemically important, non-systemically important, 500, less than 500, more than 500. NBFCs are also categorized as per the activities, which is still there, but somewhere the activities are somewhere linked to the risk that they are carrying. Earlier, it was only the activity the guidelines were more focused on the activity, but now it is more focused on the risk that each activity carries. Then, of course, last but not the least, the RBI's discretion, like RBI's discretion to put any NBFC under any radar and carry out the, and can come up with any sort of regulations at any point of time. Also, with the PCA framework, which we'll be studying, which we'll be taking later on. To start off with the applicability of the scale-based regulation, particularly as we all know, it was 1st October 2022 when the SBR was made effective. Although the guidelines came in a year earlier, and somewhere NBFCs had almost a year to gauge with the applicable regulations, the changes that they had to make, and they had a year to implement them. Of course, today we are almost 5 months down, and we are discussing this today primarily with the objective that almost many NBFCs, all the NBFCs, of course, as mandated, would have undertaken the changes. And if not, there are few more changes that need to be made effective in the current year-ending financials. So that will also help probably participants today to see that how they are equipped and what is the way forward. And of course, regulations, and another key feature of the SBR is that the regulations which are applicable on the base layer, on the lower layer, will automatically be applicable on the next higher layer. So in the entire presentation, wherever one layer is mentioned, it can be understood that it will be applicable to the next higher levels as well, layers as well, unless there is an exception that has been provided. Moving on, there are 4 major layers into which this SBR can be understood. So there is base layer, which is abbreviated as NBFC BL. There's middle layer, which is NBFC ML. Upper layer, NBFC UL, and top layer, which is NBFC TL. These abbreviations would be used in the subsequent slides. So just highlighting it for that purpose. So base layer, starting with the base layer, this comprises of the maximum number of NBFCs as on date, given the fact that the non-deposit taking NBFCs, which are less than 1,000 crores asset size, they form part of the base layer. Then there are certain categories of NBFCs which, irrespective of their asset size, will always be a part of the base layer. That includes P2P, which we all know is peer-to-peer lending, account aggregators, non-operative financial holding company, and NBFCs which do not have public funds and neither have customer interface. So these 4 categories of NBFCs will always fall in the base layer, and even if they're irrespective of the size, they will not shift to another layers. Then government-owned NBFCs will be part of the base layer, or they can at the most move to the next layer, but they won't move to the higher up layers next, other than the next level. Then ICC, MFI, MGC, and factors. Mortgage guarantee, microinsurance, microfinance, ICC, which again, ICC is what we'll be discussing in detail today, and NBFC factor. These 4 categories of NBFCs are such which can fall in any layer, and that is because of the regulations that have come through SBR, which we will be discussing later. So just for reference, these 4 NBFCs are something, and specifically the ICC being the highest in quantum today, they can fall in any layer. So understanding of all the layers and when would an NBFC move from one layer to another layer, having that awareness is also pretty important, just so that we know when we are about to reach that threshold, so that we will be falling into the next one. This was about the base layer. Next is the middle layer. So non-deposit taking NBFCs less than 1,000 crores were in the base layer, and the middle layer, all non-deposit taking NBFCs which are higher than 1,000 crores, they will form part of the middle layer. All deposit taking NBFCs, again, they will form part of the middle layer. Then again, the similar bifurcation of NBFCs which will always fall in this layer, irrespective of their asset size, irrespective of their risk categorization, or any other criteria. Standalone primary dealers and infrastructure debt funds. These 2 type of NBFCs will always fall in this layer, irrespective of any size or future risk that they may perceive. These 3 type of NBFCs, core investment company, which we know as a CIC, housing finance company, infrastructure finance company. These 3 NBFCs can fall in either the middle layer or in the next immediate layer, which is the upper layer. And ICC, MFI, MGC, and factors, as stated earlier, they can fall into any of the layers. Next comes the upper layer. So the upper layer is primarily categorized, or rather RBI has an intervention in the upper layer NBFCs to say that there is a list of top 50 NBFCs based on the asset size which has been populated by RBI. So out of that top 50, the top 10 would by default fall under the upper layer at all times. So there is no separate categorization or threshold that they need to meet, or any situation that arises that will make them fall into an upper layer. The top 10 NBFCs based on asset size will by default be a part of the upper layer. Then of course, the rest of the NBFCs, there is a separate scoring methodology that RBI will follow. So it comprises of qualitative and quantitative aspects. There is a qualitative and quantitative aspect which has different ratios, different sort of, we can say, parameters have been defined in that, wherein the calculations are done, and basis that the RBI is free to put other entities in the upper layer, of course from that pool of 50 NBFCs only. So, and of course, last but not the least, the RBI's discretion prevails in this layer as well. RBI is free to put any other NBFC from any layer into this segment in case it feels that the risk is increasing day by day, or it needs specific controls to be put in place. So till date, as we know, 16 NBFCs have been notified under this list, and out of them 10 of course are from the top asset size, and rest are based on the scoring methodology which has been followed. And just to add on, we also might be aware that recently it was in news that Tata Sons had approached RBI to remove its company from the list of the upper layer. So we are yet to receive any further updates on that. The last layer is the top layer. So this will comprise of NBFCs only from the upper layer. So any NBFC which today is in the base layer or in the middle layer cannot directly go to the top layer. NBFCs which are only in the upper layer will get shifted to the top layer, and that too, of course, only on the basis of the risk. In case the RBI feels that there is a substantial risk that these NBFCs are facing, and they need much more stringent regulations applicable as compared to an upper layer, they will shift them to the top layer. Otherwise, this layer will remain empty. So primarily, we are just left with 3 layers, which is base, middle, and upper. Next, this is just a summary of the each category of NBFC as to in which layer it will fall. ICC being on the top, as stated earlier, it can fall into any of the layers. Microfinance can fall into any layer. NBFC factor and MGC. These 4 can fall in any layer. P2P, account aggregator, NOHFC, and NBFCs not having any customer interface, they will always be in the base layer, irrespective of the size and the risk perception. Government-owned NBFCs can be in the base layer or in the middle layer. Standalone primary dealers, infrastructure debt fund in the middle layer. CIC, HFCs, and IFC can be in the middle layer or in the upper layer. They'll never be a part of the base layer. This is a small categorization of, just to understand, just from ICC's perspective, since we have been receiving a lot of queries in terms of, there has been certain confusion in terms of which layer will the ICC fall into. So if it is a non-deposit taking, the first criteria to be checked is whether it is deposit taking or it is non-deposit taking. If it is non-deposit taking, if it is deposit taking, then it will be in the middle layer or in the upper layer. If it is non-deposit taking, then 2 things again will have to be checked, whether it's a type 1 NBFC or it's a type 2 NBFC. If it's type 1, which is not having any customer interface, it will fall in the base layer. If it has customer interface and it has access to public funds, it will fall in the base layer or in the higher upper layer. Then in case it has customer interface, then again 2 things will be checked. One, if the asset size is 1,000 crores or less than 1,000 crores, it will be a part of the base layer. And if it is more than 1,000 crores, then it will be in the upper layer. Again, further bifurcation, if it is more than 1,000 crores, again, there are 2 scenarios which can arise. One would be if that NBFC is in the top 10 list based on the asset size, it will form part of the upper layer as stated earlier. Otherwise, rest all of them will form part of either middle layer or the upper layer. Now moving to the changes
Debashri,
regulation.
Debashri, before you move, I'd like to have Shan in here. Shan, just couple of questions from you to understand.
Yes, Ankit.
So the one of the questions that we also receive from a lot of our clients is that there is also a category where NBFCs doesn't access to public funds, or they don't have any public interface, which are primarily engaged in investment related activities. So why RBI wants to regulate them and require them to obtain NBFC registration? Any key reason that you foresee?
See, one is that this is only a transitionary phase wherein the RBI thought it fit to move to a scale-based regulatory regime, because NBFCs as a category of companies have grown much during the past decades, and the risk emanating from NBFCs are so systemic that it could have a much larger impact, which we had seen in a couple of years back. And NBFCs as such have a lot of access to bank funds. If you look at any NBFC's balance sheet, the amount of borrowings substantially comes from bank borrowing also, in addition to the market borrowings through NCDs and other forms of debt securities. So RBI thought it is fit to tighten the regulatory regime, considering that NBFCs almost do activities, or undertake activities which is almost similar to the banks, except the deposits. Very few deposit taking NBFCs are there today. And otherwise, in terms of granting loans, all types of loans, it's almost similar to the banks. One big difference between NBFCs and banks is that the customer type of, the quality of the customer. When I say quality of the customer, it is the credit quality of the customer. Banks do not cater to the segment of the customer where NBFC caters actually. So if you look at the profile of the customer of NBFC, he may not have a proper KYC. He may be from a very humble background. He may be a sole proprietor or a startup entrepreneur, which the banks may not, prefer to lend credit actually. So NBFCs have been, almost acting like quasi banks, and they have been supporting all these segments of the, in the society. Invariably, these people contribute to the economic activity. Most of the work done by them, the profession in which they are into, contributes to the economic activity of the country. So that is one reason, banks have been also continuously lending to the NBFCs, and it's one of the biggest chunk of assets in their balance sheet, also in the bank's balance sheet. So that is the reason RBI thought, given that NBFCs have grown in size, they have now brought the scale-based approach, categorizing them into upper layer, middle layer, and top layer and base layer. And RBI also felt there is a regulatory arbitrage between banks and NBFCs in terms of oversight, in terms of disclosures, in terms of the governance norms and everything. That is one reason they felt it's time that regulatory arbitrage is slowly bridged, at least for the middle layer and the upper layer NBFCs, and that is the reason they are bringing all these change in the regulatory norms. And
but do you find the classification equitable, or is there any scope you see?
I would say that in case of middle layer and upper layer, it seems to be appropriate actually what they have done. And I understand your query that companies which do not have access to public funds as well as customer interface, whether they can be included in a base layer or should be in middle layer and all that. If you look at the initial this framework issued by RBI, in those cases they have said they will issue an appropriate guideline separately, which is yet to come actually. So for the time being, as long as they satisfy the criteria of base layer, they will be in base layer. However, if their asset size is more than 1,000 crore, I'm sure RBI will bucket them only under the middle layer, considering their asset size, and also probably they might have taken their activities into consideration.
But irrespective of the fact that they have not any access to the credit system, they have not taken any public money. It's their own promoter money that is being used.
I understand that, but since it is a new regime which is coming into play, I think it will take some time to settle down. And in fact, if you look at the main framework which they have issued, there they have said a lot of new guidelines for appropriate, paragraphs there will be issued. So far, about 9 guidelines have been issued. All the 9 are applicable to upper layer and 6 are applicable to middle layer. And still there are some guidelines which is being awaited, which they have specified there will be separate guidelines, but which are not yet issued. So I think over a period of time, things will settle down.
Must be work in progress. I think they must be observing how the SBR is being implemented.
Even companies are, now only getting into this kind of, regulatory framework. And one more thing I would like to share is that last 2 years, the supervisory framework of RBI has also changed. Now it is more risk-based and risk-oriented. Earlier, they used to give only inspection report. Now they also issue risk assessment report along with the inspection report and risk mitigation plan. So now the approach is more towards, risk identification, mitigation, and risk control.
And I think the reason being
take some time to settle down, and we are in an evolving phase in terms of this regulatory regime, basically.
I think they are as they are becoming big. It's also important for them, for RBI to bring some sort of regulatory oversight. Otherwise, only banks will be there, and they are also having a good exposure to credit industry.
Exactly.
Okay, so Debashri, you can continue. Thanks, Shan.
Yeah.
Thank you for the insight, sir. Moving on. So now we'll be taking up the regulations one by one. The first being. Is my screen visible to?
The screen is not moving, Debashri. Okay. You have to go to the next slide.
Just a second.
Slide is not moving actually.
Yeah, looks fine.
Yeah, it looks fine.
So the first major change, as we all know, which disrupted the entire industry, was the net own funds. So talking only in terms of ICC, the existing norms, the existing threshold of 2 crore has been increased, and it has been said that the NBFCs, ICC particularly, which have access to customer interface and have public funds, they need to increase their NOF by 5 crores by March 25 and by 10 crores by March 27. RBI has been liberal in giving the time limit of almost 5 years to do this. And of course, as stated earlier, as sir also said that why our ICCs which do not have any customer interface are subject to what kind of regulations. So RBI has kept the such category of NBFC ICC from the outside the purview of the net own funds. So they can continue to enjoy net own funds of 2 crores. But the moment they have, they take access to public funds or they have a customer interface, the net own fund criteria would become applicable on them. So this would indirectly mean that the more capital infusion is required, of course. And to reach the increased limit, the profit or the reserves have to be increased. And subsequently, just from an accounting perspective, if the investment in group companies are reduced, that gap can also be reached by this way. Of course, companies might not want to do that. The only way out is to increase capital infusion. And that is precisely the reason why this has, I think, created havoc in the entire industry in terms of either they'll buy or they'll exit. And the reason behind this is somewhere, as shared earlier also by sir, that the size and the complexity are increasing at such a pace that the governing regulations, I mean, a company with a 2 crore or a 3 crore portfolio cannot inherently be assumed or cannot be expected to do an activity wherein it has customer interface, it is taking public funds. If it is actually involved in the business and it is scaling at that level, then of course, with the scale of the operations, the size of the asset side, the net own funds also should be increased by default. The next aspect is the common equity tier 1 capital, which is applicable only on the upper layer and the and above. Going back, net own funds is applicable on all the layers, so there is no exemption in this. Just to clarify, common equity tier 1 capital, this states that this common equity tier 1, which is CET1, it is abbreviated as CET1. This should be at least 9% of the risk-weighted assets. So the existing regulations talks about only the capital, which is tier 1, and it says that capital should be at least 15% of the risk-weighted assets, the total risk-weighted assets, or out of which tier 1 should be minimum 10%, and the remaining can be tier 2, and tier 2 at any time should not exceed tier 1. Now, this CET concept has been borrowed from the Basel guidelines, and it is applicable on banks, and that is the reason why only the upper layer NBFCs are expected to follow this. The intention is somewhere to bring them at par with the banks, as we have been talking earlier, that the bifurcation between banks and NBFCs, of course, still remains in terms of activities undertaken and the outreach that they have. But in terms of the risk perception, it is somewhere more or less close to a bank. And that is precisely the reason why the capital that they are expected to maintain has been taken from the Basel guidelines. And if we break down this entire component, it would mean that the 15% of the risk-weighted assets, the 15% of the capital, that regulation still remains in place. There is no change in that. Only the upper layer and the above NBFCs have to ensure that out of that 15%, the first 9% is CET, the rest 1% can be tier 1, and the balance 5% can be tier 2. This is just a way of, maybe we can say, to understand how the CET1 will impact the tier 1 only for upper layer NBFCs. Then moving on, the next important aspect, the regulation that has come into place is the internal capital adequacy assessment. This is for middle layer, upper layer, and above. Top layer if any NBFC gets categorized into that. So the main concept behind this is, of course, it has been introduced for the NBFCs for the first time. Again, this is a concept which is applicable on banks. The reason why it has been introduced for NBFCs now is that the current norms which define the quantum of capital that an NBFC needs to have, it does not take into account all the risk factors. And with this ICAP, the basic premise of ICAP is to identify the capital based on the different kinds of risks that an NBFC can face, based upon its activity, based upon its exposure, and based upon a number of other factors, which generally a bank does. So this is recommendatory in nature, but it is expected, RBI expects that the companies would actually take this assessment because it will somewhere help them to determine the capital requirement in a much better and in a comprehensive way as compared to just a blank, a consolidated number that exists as on date. So in this, the existing that we have, as I shared earlier, that all the risks are not taken into account. So this ICAP would be in addition to the existing capital adequacy ratio that the NBFCs are following. Also for this ICAP framework, a detailed assessment has to be done at the board level also. Various parameters, maybe we can take this up later one by one in case that, there are different kinds of parameters that are defined in the ICAP. Each parameter, each asset has to be defined under that. It can be, and then the entire board report needs to be submitted to RBI, and then basis that, the final capital that is determined, that will be submitted to RBI, and then it will be finalized. The board cannot do it at it has to be done at a board level and not below that. It cannot be done below that. So it has to be done at the board level, and permission from RBI is needed in terms of statutory report, which needs to be sent to RBI with this entire calculation.
I can add a few points to that actually.
Yes, sir.
Yeah, this ICAP is basically, because of the risk faced by NBFCs, this ICAP is being introduced. So RBI now wants the NBFCs to identify the capital requirement based on the risks for their assets. Basically, the assets of the NBFCs comprise of loan assets, which are into various categories of loans, and each type of loan has its own, risk categorization. Some may be, of low risk. Take, for example, a housing loan or a property loan may pose a lower risk, whereas a loan given to an unorganized person may pose a higher risk. So based on that, there will be different levels of capital required. So the RBI expects, this is in line with the Basel III norms, which RBI issued in 2015 for banks actually. So the scale-based regulatory framework mentioned that, the NBFCs have to follow the pillar 2 of those guidelines, which exactly means that the RBI will have a supervisory overview of this assessment. This assessment will not be a one-time exercise. Initially, the company will do this assessment. This will be reviewed by the RBI during the course of inspection, or even they can in between ask for the details from the NBFCs concerned. And basis their assessment, they may either agree or they may give suggestions. They may even ask NBFCs to go for a higher capital requirements actually. So as Debashri was saying, all NBFCs have to have a board approved policy. By this time, all companies is supposed to have it actually. And it also has to be reviewed, if I'm not wrong, it is at a frequency of 1 year. It has to be every 1 year, it has to be reviewed with respect to the policy, and then any changes to be made, or any changes or increase in capital is required. Accordingly, the NBFCs have to act upon. Yes, go ahead.
So it means that board has to consider the customer profile in general to create some parameters basis which the credit assessment will be taking as and when the loan process is initiated.
Not only the customer profile, I would say, from the RBI standpoint, how they look at an NBFC is not only from the customer profile, they also look at the overall business model. Today, you may be present in one product segment. Tomorrow, you may come out from that segment, get into a new product segment. They look at your budgets, or what is your plan for the next horizon of next 3 years, 5 years. So basis that they consider whether your capital is adequate to face the risks which you have determined or which you are about to undergo. So it is not just in line with the current exposure or the current customer profile. The RBI also takes into account the overall business strategy of the company basically.
So it becomes then much important for a company which are into lending into different segments, as opposed to like there are certain companies which only lend in one segment. So for them, it's much easier as opposed to the others.
Yes. For example, take for an example, NBFC getting into digital lending through a separate subsidiary. Okay. In case those NBFCs, may not provision additional capital, they may feel that it's in the incubation period, or it will take some more years for them to stabilize and establish. But based on our experience, RBI doesn't look at it that way. The moment you diversify into new business, or you get into new business, whether you have the adequate capital to keep channeling into that company is what they look at actually. So for them, the capital adequacy is something, not only in the current form, but also whatever is the future plan or your business plan, they take that also into account. That is the reason they have also advised, specified in the framework that it has to be reviewed, at appropriate intervals.
Okay. And as a compliance officer, does it falls under your domain to make sure that the compliance is done? Or it's generally
by the, finance functions. And even some of the finance section in some of the companies, they also take additional external help. As of now, RBI is not expecting any statistical models to arrive at the capital adequacy assessment basically at present. But there must be some sort of process or model which you should be able to establish that you are arriving at the assessment is your completion of assessment is robust, logical, and it satisfies the expectations of RBI.
Thank you. Thanks for the feedback. So Debashri, please continue.
Moving on to the next. Leverage, as we all know, the existing, the current leverage ratio is specified as 7. And RBI stated in the SBR that it will come up with additional requirements, which is yet to come. Another major change has been in the asset classification norms. As you all know, now 90-day overdue period has to be followed by all the NBFCs. Earlier, the non-systemically important, which were less than 500 crore NBFCs, had the privilege of using, of keeping their net NPAs, of classifying the NPAs of accounts which were only older than 180 days. But now they also have to follow the 90-day period. And for this, a timeline has been given by RBI. Of course, else it would have impacted the financials in one go. So from 180 to 150, it has to be reached by March 31st, 2024. Then it has to further come down to 120 days by March 25, and by March 26, it has to follow the 90-day period now. Currently, as stated, the non-systemically important NBFCs are following 180 days overdue period. So with this SBR kicking in, and the non-SI, which is the small players, also have to follow the 90-day period now. This would bring all the NBFCs on the same footing, and it will not allow the non-systemically important, rather the small NBFCs, to take advantage of the extended period. And of course, evergreening is a byproduct of this extended period norms, which generally, as we all know, in the industry has been exploited, and it is not permitted, evergreening of loans. And also the short turnaround time of the bucket shifting would lead to quicker identification and subsequent write-off from the books, which means that in case the more the period, the larger the period, the higher the period a loan is sitting in say the doubtful bucket, the more it will linger on, and eventually it will have to shift to the another bucket, and eventually it will be written off. So the quicker it is done, the turnaround time, with the reduction in turnaround time, the NBFC will be able to have a clean book. Not clean in the sense, it will, in case it sees that a loan is going to become an NPA, it won't have to wait for that entire period. Of course, it can shorten the period, but there is no regulatory arbitrage that it can take any further. It will have to shift it to the next bucket in the given time period. So, any further inputs on this from your end? Any further impact?
Also required is 90 days and not a very aggressive period.
Aggressive period, actually 90 days, generally it has been followed by banks and NBFCs. The systemically important NBFCs were also following this. MFIs are also following this. So I think it is somewhere wanting to bring the non-systemically important NBFCs into the same space. I think that's one of the reasons which I can think. So your inputs on this?
Yeah, this RBI has felt that that NBFCs have to move to the 90 days norm, which we have moved already. But earlier we had some sort of gray areas as to on the computation of 90 days. Now RBI has clarified through the November 12, 2021 circular that you will have to compute on a day-end basis that if at the end of the day the account remains is unpaid or it's not standard, then if it crosses that 90 days period, it becomes an NPA. What they have clarified through the November 12, 2021 circular is that once asset moves into an NPA, suppose even if out of 3 installments, 3 EMIs, 2 EMIs is paid, 1 is only pending, then you cannot consider it as standard account. It will still remain as NPA. Unless and until the entire principal and interest for the default period is being paid, it will remain as a NPA. That is what this November 2021 circular has clarified. Earlier, there are interpretations like, out of 3 EMIs, if 2 is paid, only 1 EMI is pending, so it will not be considered as an NPA. All that has been clarified now. Now it is like, unless all the outstanding EMIs is paid, it becomes an NPA, and if it crosses 90 days, it will become an NPA. Yes.
Moving to the next, in terms of exposure norms, so 2 key areas have been identified as RBI as the sensitive sectors. One is the capital market and the other is the commercial real estate. NBFCs in the middle layer and in the upper layer have been suggested to set board approved limits so that they don't breach their own limits and make humongous investments in these two sectors, these being the more critical ones and having much more higher risk. So somewhere NBFC is wanting to safeguard the investment, the exposure that the NBFCs take in these two particular segments. Within the commercial real estate exposure ceiling, a sublimit for land acquisition financing also needs to be set internally. Of course, internally, all these, wherever internally is mentioned, it means that a board has to set the limits. Sublimits within the overall SEC limits can be freely determined by the board. So companies are free to define the sublimits. And another major exposure norm is the ceiling on the IPO funding, which we all know. So there is a cap of 1 crore that has been put. NBFCs can make it even more stringent. So as we all know, this IPO funding, currently it was applicable only on banks. Banks had a limit of around 10 lakhs on this capping. There was a capping of 10 lakhs for banks. But for NBFCs, it has been introduced for the first time. Given the fact that the exposure also is more or less as good as banks, and the financing in this area is also increasing day by day. Another thing in terms of exposure norms applicable to the middle and the upper layer is internal limits need to be determined by the board in terms of any other sector apart from these two sectors which has been identified by RBI. So apart from these two, if there is any other sector which is particular to a specific NBFC, the NBFC is free to identify that, bring it out on paper, and also set limits for that. Then moving on to the concentration and the exposure norms. This is again not applicable on the base layer, but to the middle layer and the above layer. So earlier we had the capping of which was bifurcated into lending and investment. 15% of the own funds, 25%. 15% when it comes to single borrower or single party, both for lending and investment. And when it comes to a group of borrowers or parties, it was 25%. Now the lending and investment, it has been clubbed together, and now it is 25% of tier 1 and 40% when it is for a group exposure and 25% for single exposure.
The objective of creating this, exposure limits entity wise or group of borrowers wise is that to essentially to plug the risk exposure of the NBFC, because too much of too higher an exposure to a group of entity or a single entity would again impact the capital adequacy of the company. So earlier the limits, as the Debashri said, it was separate for lending, it was separate for it was combined for lending and investment actually, and currently they are bifurcated into lending 15% and investment 15%, and earlier it was on the owned funds. Now it is anchored on the tier 1 capital. That is the difference between the earlier limits and the current limits actually.
So this would, as we know, the tier 1 is less than the own fund. So somewhere indirectly RBI is wanting to curtail the exposure that these
NBFCs a conservative approach now actually.
Right, exactly. So earlier they were free to play within the thresholds, but yes. Now, they were restricted in fact, but now they can do it, but the overall capping has been reduced again.
Correct.
So the motive is, as stated, is to reduce the overall exposure and the risk. Next, moving on to the large exposure framework. This is applicable only for the upper layer, and this will be applicable the upper layer unless this was identified, this was notified. Till that, the existing regulations that we discussed, this was the previous one, the current exposure limit, the upper layer NBFCs were required to follow the current exposure limits, what we just shared, until the large exposure framework has been put into place. So this large exposure framework is only for upper layer, and it states that the capital has to be on the basis of tier 1. The exposure has to be calculated on the basis of tier 1. And upper layer NBFCs need not to follow the current concentration and exposure norms, but the large exposure framework, which has been put into place specifically for the upper layer. For single counterparty, it is 20% without any approval, without any, of course, as per the policy, but 20% is the minimum that it can take exposure. additional 5% with board approval, and additional 5% in case exposure towards infrastructure, loan or investment. When it comes to group, connected, interconnected parties or group, it is by default 25%, and additional 10% exposure can be taken if it is towards infrastructure or loans. The percentage has to be calculated on the eligible capital base, which is a tier 1 capital.
That is
Again,
capital plus profits accrued during the year.
Right, profits accumulated losses.
Accrued during the year with some adjustments actually.
Right. So there's a detailed circular also which came into this detailed calculation of how the CET, of how this calculation, this exposure, I mean, wherein the what is large exposure exactly, that also has been identified. It also has been defined what all exposures are forming a part of large exposure. And then, of course, the entire calculation has been detailed out by RBI in one of its notifications as well. So you would want to add anything to this? Your inputs on...
Nothing specific actually.
Moving to the next, IPO funding as discussed. Unlike the other regulations which are effective from October 22, 1st October 22, this came in, this was supposed to be, sorry, this is a typo, this was April 22 actually. This was right after the SBR regulations came in 2021. This was supposed to be effective from 1st April 22. And as stated earlier, this limit has never been imposed on NBFCs before. It was only for banks with a limit of 10 lakhs. But for NBFCs, the limit of 1 crore has been put. Of course, more stringent more stringent norms can be defined by NBFCs. They are free to do that. Moving to the asset provisioning norms, only the standard asset provisioning norms have been, there has been a change in this, only for the upper layer. The primary reason can be understood as since RBI has identified the sensitive sectors, which we discussed just a while ago. So primarily RBI is wanting to put a much more buffer to these sensitive sectors, to the exposure of these sensitive sectors. And that is why even at the standard level, the standard assets, I mean the exposure that fall in the standard category, even they need to be identified, and separate provisions have been allowed for them. So currently there is a consolidated percentage of 0.25 for non-systemically important and 0.4% for systemically important NBFCs for all the exposures across the entire standard assets. But now with the sensitive sector exposure, these limits have been identified and the provisioning needs to be done as per the table that we all can see. If it is individual housing loan and loans to small micro enterprises, the provisioning remains at 0.25. If there are advances to commercial real estate and residential housing sector, the norm, there is a higher provisioning that needs to be done, which is 0.75%. Exposure to commercial real estate has to be 1%. And all loans and advances other than the above 3 need to be at 0.4%. So this is only applicable for upper layer. The existing IRAC norms will be applicable for middle layer and the base layers. Another major change. Sorry.
Just one point, it may be evident from the above slide, the slide that, depending upon the, the next one, the rate of provision is basically, based on the, risk category of the asset. If you look at, for housing loans and loans to SMEs, that probability of default is much lesser and hence the provisioning rate is lesser. And similarly for real estate, residential housing, it is slightly higher than the individual housing loan. And for commercial, it is higher. So it is actually tied to the risk categorization of the loan asset per se. Yeah, go ahead.
Next important and I think a very common topic for discussion amongst in the board is loan to directors, senior officers and relatives of the directors. So these new regulations have been put in place for under the SBR. So board approved policy has to be in place. One, of course, earlier the small sized NBFCs did not of course, there was no restriction on it, but generally NBFCs did not, or rather small companies did not make any policy as such when it came to giving loans to directors and the KMPs and their relatives. So this concern has been identified under the SBR, and now for the base layer, which includes even the NBFCs which do not have customer interface and which do not have public funds, even they need to have a board approved policy, and they need to set the limits as to up to which limit can the loans be given to the directors, senior officers, and relatives. The policy to grant loans to directors, senior officers, and relatives, and to the entities also where these directors or the relatives have major shareholding. This has also been included in the ambit of the people to whom, or the entities to whom loans can be given. Then, so the policy has to include a threshold beyond which loans have to be reported to the board. So there is still a certain leverage that has been given in terms of maybe a minimal amount which the company can give without going to the board. But NBFCs must follow this, and they should set limits as to beyond which board approval needs to be taken, so that it ensures ultimately complete transparency in terms of where the funds of the company are being invested or given. Looking at the right side, this is the top four pointers are applicable only on the base layer. And if we look at the entire table is applicable for middle and upper layers, which means these if it is more than 5 crores, the remaining these provisions are not applicable on a base layer NBFC. Loans and advances of more than 5 crores, it must be sanctioned by the board. So it means that a base layer can sanction loans and advances of more than 5 crores. It need not get the committees or the board's approval in that. But yet again, it does not mean that it should, it would be prudent for even the base layer NBFCs to set limits closer to 5 crores in their policies as well, just so that they don't breach or take undue advantage. And probably RBI might also come up with certain regulations in the times to come, in terms of maybe putting capping even for the base layer NBFCs, which as on date is not so risky, and that is why has been kept outside the purview. Loans and advances to senior officers shall be reported to the board. Senior officers have been defined. This is a new term which has been identified. It does not, senior officers is not identified even in Companies Act. This is a new term which has been identified under the scale-based regulations. A declaration needs to be obtained from the borrower containing the relationship and with the director and the relative to whom the loan is being given. So declaration would state the entire the connection that the person or the entity has with the company or the director. That would help in determining the probably the layers into which the money is flowing into. Then no senior officer or any committee comprising the committee that needs to be formed. So no senior officer should be a part of that committee which is sanctioning loan to its own relatives. And loan exposure to real estate. This is another important point. Loan exposure to real estate sector has to be ensured that the borrowers have adequate permissions. It should not happen that the entire due diligence process and everything is done, and then it seems that the borrower cannot be given exposure to this, cannot be exposed to real estate sector loan. So before even applying, NBFCs are, of course, I believe NBFCs would be devising some action plan behind this, in terms of at the first checkpoint only, they should ensure that the borrowers have adequate permissions, and only post that they will move on to the further due diligence and the acceptance policies and other things, and onboard the borrower finally.
Yeah, one couple of points there, Devashri. See, in terms of policy, though the regulation mentions that the base layer NBFC shall have the policy on grant of loans to directors, there's a school of thought, whatever applies to base layer, it applies in toto to the middle layer and upper layer.
Right.
So, however, in terms of middle layer and upper layer, there are detailed guidelines which have been issued by RBI on the loans to directors and their relatives and the entities in which they are interested. So ideally, either the companies in middle layer and upper layer can consider to have a separate policy in line with the guidelines specified, or these middle layer and upper layer companies can include a clause in their credit policy and loan policy stating that, with respect to the loans to directors and their relatives and non-senior officers, they will be guided by the guidelines issued by RBI from time to time. I think that would also be adequate compliance in this regard. And in terms of internal process, ideally the company's NBFC should, as a matter of routine, as a part of their quarterly reporting to their credit committees or board, they should internally set up a process to get the details from the HR as well as the credit or loan sanctioning team to understand whether any loans have been granted to senior officers, and then report to the credit committee as well as the board, though it may be lower than the threshold limits actually. So this way it will help to keep monitoring the such kind of loans, if at all, if anything has been given. Other one is to, as Debashri said, it has to be made as a part of the loan agreement and get a declaration from the borrower that is not related to the director or senior officer of the company. And senior officer here, as per the guidelines, has been defined as senior management under Section 178 of the Companies Act, where it has been defined, the word senior management, which essentially means the one level below the board members, as well as includes functional heads and KMPs basically. And in terms of other loans which the company may grant to its employees, suppose the company has a policy of, for instance, housing loans to its employees, and there is a separate policy in that regard. Those kind of loans may not come under the purview of these guidelines because there is a separate policy and it is applicable to all the employees. So those instances, if the company is able to establish the bona fide, such kind of loans may not come under the purview of these guidelines. Yeah, that's it.
Awesome. And so in terms of, as you stated, if in case there is a company, then in that case, will not the company at times take advantage or rather exploit this particular thing in terms of preparing a separate policy and giving benefit to the employees?
That is what I'm saying. It should be applicable to all the employees. Any employee should be able to avail it. That will only establish the bona fide. The company cannot create a policy and give only to senior officers and say they are only eligible. In that case, there is no bona fide there actually.
Companies generally make policies, but
there are companies which have, there are companies which have this loan facility for their own employees at a concessional rate. So if it is as per the policy duly approved by the board or the management, ideally to be approved by the board or any committee. And if it has been, say for instance, if there is already been such a policy prior to the issuance of these guidelines, so that itself is will establish the bona fide. Suppose if the company wants to bring in a new policy like that for the employees as a part of the employee benefits or compensation benefits, as long as they can establish this bona fide that it is applicable to all the employees, not to specific category of employees, then I don't think it will be an issue.
Right. So moving on to the next, there are certain matters which, of course, they have been discussed in detail. Just one pointers in the SBR framework, but pretty important from company's perspective. So experience of the board, as we all know, there's already a fit and proper criteria. But with the SBR, it has been clearly identified that at least one director should have past experience of working in a bank or an NBFC. Of course, as we know that while applying for a new NBFC or in terms of whenever there is change in control or any such scenario, the details of the directors are already being taken. And even then they see that whether the director has a past experience with an NBFC or not. But now it has been clearly stated that even new companies that would be undertaking registration, they'll have to ensure this. Limit has been imposed on the number of directorships of KMPs and the independent directors. So this is applicable only for middle layer and the upper layer and the layer above the middle layers, not applicable on base layer NBFCs. So KMP can hold directorship, cannot hold directorship in any other middle layer NBFC or upper layer NBFC except in its own subsidiary. So if there is a KMP who is a director in a middle layer NBFC, at the most can hold directorship in its subsidiary and not in any other middle layer or upper layer NBFC. Similarly, there is no, and of course, there is no restriction on the base layer NBFC. So if there is a director in a if there is a director on the board of a base layer NBFC, he or she can become director of one of the middle layer NBFCs. And if there's a director who is appointed in, say, 2 or 3 boards of base layer NBFCs, there is no restriction in that. This is somewhere probably to the intention behind this is to ensure that there's no conflict or maybe clash in terms of the decision-making process of 2 NBFCs. Or maybe, so you can add more into this. Independent directors, similarly, the same goes, cannot be on the board of more than 3 middle layer NBFCs. Independent directors, since they are not completely involved, so they can be a part of 3 companies at the most, not beyond that. Again, not applicable on base layer NBFCs. And compared to the other regulations which were required to be complied by 1st October 22, a timeline of 2 years has been given, so that in case there is a director who is, let's say, a part of 2 upper layer NBFCs, for example, the NBFC will have adequate time to look for a replacement, and then the transition period can be taken care of.
In case base layer NBFC moves to a middle layer or a middle layer, then the independent director, in order to fulfill this limit, has to resign from either of them.
So independent director, again, for
so
base layer,
there's a limit of 3 middle and upper layer.
There's a limit of 3 for middle and upper layer.
So if a base layer, for example, converts into a middle layer, then he will have to definitely select someone, either of them.
In case there is already, that person was already a director in 2 companies and that base layer shifts to middle layer and it becomes 3 or other 4. So the limit needs to come down to 3, and the person will have to resign from at least 1. That's why, to taking into consideration such scenarios, I believe the timeline of 2 years has been provided for a smooth transition.
But that would be, I don't think that would cover this scenario, because it cannot be forecasted, may arrive after 2 years also.
Of course. So that's where the day it comes into that layer, from that date, 2 years will be counted. So the director will have ample time and the company will also have ample time to look for a replacement, and the transition can be taken care of.
Yeah, but that would be for the independent directors who are already serving on more than 3, most probably. That is for the transition is for them.
Transition period is also provided for the KMPs as well. So this transition timeline has been given for the KMPs also, who are currently, what we discussed just a while ago. In case there is any director who is in a middle layer NBFC, and let's say 2 middle layer NBFCs, which is not a subsidiary, forms part of different group. Even then, the day it gets categorized into, say, middle layer, from there, a timeline of 2 years has been provided. So for 2 years, they can remain in, say, 2 different middle layer NBFCs. But after 2 years, they'll have to step down from one of the companies. So this transition period has been given for both KMPs as well as the independent directors as well.
Yeah, Shan.
Couple of points with respect to this limit on directorship of KMPs. So the idea is basically to ensure there is no conflict of interest. That is point number 1. And point number 2 is that RBI sees NBFCs as a highly regulated entities, where all the activities of NBFC, each function in an NBFC has some sort of regulatory aspect or compliance. So RBI sees a regulated entity, that way. Hence, they don't want the KMPs or the senior management of the companies to divert their focus or attention from their own company, so that the time and efforts does not get diverted, and as a result of which that particular regulated entity suffers. That is one reason RBI has been very categorical that in terms of limiting the number of other directorships, both from the conflict of interest point of view as well as the attention required to manage an NBFC. And with respect to the limit on independent directorships, it is ideal as a process as a part of annual disclosure, NBFCs can start getting a separate disclosure on the NBFCs in which they are directors, including, the format containing, including the category of NBFCs. That will help us help these companies to keep track and also advise them or, alert them on the need for the compliance in this aspect.
Yeah, carry on, Devashri. You have to unmute.
Another few concerns or other major things that have been added, not for the base layer, but for the middle layer and the upper layer. In case there is any independent director who is resigning before the tenure, needs to be informed to RBI beforehand. Independent compliance function, chief compliance officer needs to be appointed mandatorily for middle layer and above. Not applicable on base layer. Base layer NBFCs have been spared from this. So this chief compliance officer, there has to be a proper policy behind this in terms of the detail, the clear deliverables, the clear timelines, the clear exposure in terms of the work exposure and the decision making. Everything needs to be framed in a policy. Qualification of board members, again, upper layer. This somewhere can be used by the other NBFCs as well, but upper layer specifically has to make sure that there is a mix of good educational qualification and experience of the board members, and they should have specific expertise based on the type of the business they are in. So let's say if it's an MFI, then one of the directors should have probably maybe would have worked in an MFI or should have been a director in one of the MFIs earlier. Moving to the next. Risk management is something that has been applicable on all the layers now. Earlier, a few NBFCs were exempt, were kept out of the purview. Now, risk management committee has to be made by all the NBFCs, irrespective of the layer they are in, and it can be at the board level or a level below the board. And all the risks that the NBFC is currently associated with or they are exposed to, it has to be in the ambit of the risk management committee. And the committee needs to submit the report to the board level. Board committees, again, role of different committees to be specified along with the calendar of reviews. Of course, this is already, many NBFCs have these specific committees, but the SBR only states an additional thing that the calendar, the entire calendar of when the committee would review their respective TORs and everything needs to be specified. Compensation guidelines have been introduced. Of course, there is a remuneration committee, and which NBFCs already have. It just states that the compensation guidelines need to be clearly identified and come under the ambit of the remuneration committee, only for the middle layer and above NBFCs. So board approved policy has to be put in place for constituting the remuneration committee if it did not have such committee earlier. Then guaranteed bonus, principles of, the entire principle of all the principles of the compensation, whether it's a fixed variable pay, everything needs to be spelled out clearly.
A couple of points in that slide, Navashri. In terms of risk management committee, in case the NBFC is a listed company, they will already have a risk management committee. That committee itself will suffice for this purpose. And in terms of other board committees in the company, they will already have the other committees that should suffice. And the compensation guidelines also specify the need for a nomination and remuneration committee. And they have referred section 178 again, that will be the committee for this purpose. If you look at 178, it also requires to have independent directors. Suppose if the NBFC is a private limited company, it will not need to have an independent director. Then there will be a question, there may be a question whether if the NBFC is a private company, whether it still needs to have an independent director. As this framework this compensation guidelines refer to the Companies Act, one view which can be taken is that since they have referred to the Companies Act, there may not be a need to have an independent director, even if it's a private company. Suppose if the NBFC is a private limited company. But however, given the nature and objectives of these guidelines, RBI, in my view, may expect even if it's a private company, it may have to have some independent directors. And again, on the compensation guidelines, some of the points which one has to factor is like, because it has specifically said like the compensation policy of the company should be risk aligned, and there must be some clawback provisions wherein the any variable pay or some, payment which has already been given, the company must be in a position to take it back when such a situation arises. Malus is a provision wherein you are supposed to pay something and which you are retaining it without paying. So all these aspects have to be well thought out, because the company might have already issued ESOP, some might have got vested, some might not be vested, some might have vested, not exercised. That could have been prior to the issuance of guidelines. Post issuance of these guidelines, how that will, that those aspects have to be handled is something which the management has to, carefully craft in the policy and then, complete the policy having regard to various aspects. The guidelines specify that the policy has to be approved by the board actually. So ultimately, the decision to have a clawback or to invoke a clawback or invoke a malus has to be taken by the board or the committee appointed by the board for this purpose, rather than the management, because that will be a better appropriate way of doing it. Yeah, go ahead.
Right. So moving on, whistleblower mechanism is something that needs to be put in place. Of course, many NBFCs already have it, but now it has been mandated for middle layer and above
exactly
NBFCs.
Similar to what is given in the listing regulations.
Exactly. So somewhere SBR has tried to capture the best of the available regulations from all the concerned authorities. Corporate governance of subsidiaries, something very silent, but yet RBI has spelled it out with the SBR that board needs to ensure the subsidiaries are also following the apt guidelines, and it cannot say that it is a subsidiary and it cannot carry out activities that are beyond the regulations. So if it is a subsidiary, it is a responsibility of the holding company to ensure the guidelines. Core banking solution, NBFCs with 10 or more branches are mandated to adopt core banking solution. A glide path of 3 years has been given. So by 2025, 1st October, the middle layer and the above NBFCs have to adopt the core banking solution. Another major introduction in the SBR has been the mandatory listing of companies which are in the upper layer. As we read, as of now, 16 companies have been notified by RBI in the upper layer. So the day in which they are notified, 3 years from then, these companies have to mandatorily get listed. And of course, follow the SEBI LODR regulations and everything, and also prepare a framework of how they would follow that, how they would reach to that period.
Yeah, one point on this once again. One point I have in this core banking. As such, the guidelines specify that any NBFC which has got a customer interface with more than 10 branches, they have to conform to this core. It's not core banking actually; it is core financial CFSs actually. This is something similar to CBS of which is followed in banks.
Banks.
And core financial services solution it is actually. And though the regulations give a glide path of 3 years, effective this March quarter, all NBFCs to whom this is applicable, that is both upper layer and middle layer, have to submit a report to the RBI stating what is the progress on this, what is the milestone to achieve this CFSs, which has to be approved by the board. So ideally, companies have to get it approved anytime before 31st March by their board. What is the plan for implementing the CFSs and what are the milestones? And then they will have to submit this with the RBI. Though specific timeline has not been set within how many days from 31st March, the companies have to report to the RBI, but the reporting quarter gets triggered by this forthcoming 31st March. Go ahead,
So moving on to the next, certain disclosures as stated since there have been so many changes in the risk perception and the overall working of an NBFC. So starting March 31st, 2022, when the books will be closed, these additional disclosures need to be made in the notes to the accounts. Exposure to real estate, capital markets, sectoral exposure, intra-group exposures, related party disclosures. Disclosure of course, all these exposures are only to be done in case NBFC has one. In case there is no exposure, then it can be skipped. It need not mention nil, I believe, in the financials. If it is not there, it can be removed. One important point included here is the disclosure of complaints from the customers and the ombudsman office on the grounds of complaints. This is more so very important from the perspective of NBFCs which have customer interface. Earlier, generally the practice has been that companies have grievance redressal policy, and they just submit a report to the board with the list of the complaints that came during the year or the quarter. But with this SBR, the details of all the complaints, in fact, the grounds of the complaints, the number of complaints, everything has to be disclosed by all the NBFCs. None of the NBFC has been spared from this, including the base layer. So this is a very important disclosure that needs to go, and correspondingly, a lot of background work also probably will have to be done by all the NBFCs in terms of establishing proper committees and proper departments to monitor and take care of all these complaints. Few more disclosures. CGR report needs to contain the composition and category of directors. If there is any modified opinion by the auditors, then that also needs to be disclosed.
Debashi, your voice is lost.
Is it better now?
Yes, now it is. I think it was internet issue.
Just let me know in case it goes off again.
Yeah.
So breaches.
I'll request you to hurry up a little. We are already short on timeline.
Okay, a lot of provisions to be covered. So maybe I'll quickly just sum up with what's written in the screen, and we can maybe take a few questions if time allows. Important point out of the entire list is probably the covenant breaches that have occurred in terms of any debt security which has been issued by NBFC. So generally, then the NBFCs, this disclosure would enable anybody in the public domain to see whether what all breaches have been done in terms of any covenant breaches, and this will enable the future maybe lender to take a more informed decision in terms of the health of the NBFC to which it might fund in future. Any change, any divergence from the asset classification or the provisioning norms, of course, need to be given. Composition of the board, summarized TOR, details of compliance with Companies Act, penalties imposed by RBI, instances of breach of covenant of loan or debt security or listed debt securities. Resolutions passed at the general body meetings also need to be disclosed in the notes to the accounts now. This was something that was not there earlier, I believe. And another important point with respect to upper layer is since they need to be listed within 3 years of being identified as a middle layer, as an upper layer NBFC. So they need to disclose a roadmap also, like we just discussed in terms of the glide path whenever it is given. Although RBI has given a glide path, but it also needs a disclosure or a roadmap as to how the NBFC will achieve that. One small discussion in terms of the NBFCs that would transition to the upper layer. There is nothing specific which has been mandated under the SBR for the NBFCs which would transition from base to the middle, but
Debashi, your voice is not up there.
Is it better?
Yes.
Yeah. So transition, when any NBFC is transitioning to the upper layer, within 3 months, it has to put up a policy of what additional guidelines it has to follow. And of course, it has to be met within next 24 months, because in the next 1 year, it needs to get listed. That is why a period of 1 year has been given to make all the other arrangements for listing. Also, if an NBFC gets categorized into the upper layer, it will remain in the upper layer for at least 5 years. And if it does not meet the criteria for 5 consecutive years, then it will get removed from the upper layer and it will come back to the middle layer or the base layer, as the case may be. NBFCs which are about to reach the upper layer, they will be intimated by RBI beforehand, and they can take a call and modify their operations accordingly, whether they want to go to the upper layer or they want to remain in the middle layer. This is a small synopsis of all the regulations we discussed with the timelines. Generally, all the regulations by default are applicable from October 22 effective, but there are few with certain exceptions, net owned funds being the one where glide path has been given. Ceiling on IPO funding, as stated earlier, it was applicable from April 22. NPA classification, again, there's a glide path. Leverage, whenever prescribed. As of now, the extant regulations are only applicable. Related to board matters, all of them are applicable from 1st October 22. Mandatory listing, as discussed, only within 3 years. Compensation guidelines can be put into effect from 1st April 23, which is from the next financial year. Co-banking solutions, again, as glide path has been given, so maximum by 25, it has to be in place. And that is probably the reason why RBI is asking to submit a report by March, because it involves a lot of integration, backward integration in terms of operations and accounting and everything. This was for the SBR. We have time permits. I'll quickly run through.
Yeah, if you can quickly run through.
Other certain major developments. Prompt corrective action, as we all know, this is a concept which was there for the banks. For NBFCs, it has been included. It has been introduced for the first time. Of course, RBI also had a discretion earlier also to step in and put regulatory restrictions on any NBFC, but now a proper framework has been put similar to banks, and it is applicable on all NBFCs except base layer and NBFCs that do not accept public funds or do not have any customer interface. It is not applicable on them. It will be applicable from 1st October, as and when the SBR got kicked in. It will be applicable parallelly, and it can be very well understood that the basis why the SBR was introduced was to somewhere increase the risk, monitor the risk that every NBFC is facing. So with this PCA being aligned with the SBR, now RBI has full control in terms of monitoring each and every activity risk, and with the limits defined, it will be pretty easy and structured in terms of identifying which NBFC is going into which kind of risk, so that any major lapses can be plugged in the initial stages itself. So it kicked in from October 22, and the basis would be the balance sheet, the audited financial statements of March 22. Any NBFC would fall or come under the ambit of the PCA framework based on the audited annual financial results and not the unaudited, to be precise. And of course, if there is any supervisory assessment made by RBI, and that can go beyond the thresholds which we will be discussing later. Once an NBFC enters into the PCA framework, like banks, wherein they continuously monitor the operations and everything, it will come out of the ambit, it will come out of the PCA framework only if there is no breach or all the for 4 continuous quarter financials, and it is only after that an NBFC would probably come out of the PCA framework. If there is supervisory comfort, the RBI feels that the NBFC has taken probably complete care and actions and appropriate actions to ensure that the profitability and the sustainability of the operations would remain, then also in that scenario also it can take the NBFC out of the purview of PCA framework. These are the threshold. One CRAR, first threshold is the capital to risk asset ratio. If it goes beyond 12 but less than 15, it will trigger the first threshold. If the tier 1 capital ratio goes above 8% or less than 10%, then it will come under the threshold. Net NPA ratio, if it goes above 6%, then also it will trigger the threshold 1. Similarly, threshold 2, if it goes beyond 9, less than 12. If the tier 1 capital goes beyond 6 but is less than 8. Net NPA, if it goes beyond 9 but remains within 12, then the second threshold will get triggered. Third threshold will get triggered if the CRAR falls below 9%, tier 1 capital falls below 6%, and net NPA ratio increases above 12%. The reason is probably, as
one
discussed,
point in the previous slide, yeah, as a matter of prudence and good practice, what companies, bigger companies and middle layer companies do is that they have an internal lower threshold. For example, an NPA is 6%, mean they will have 4.5, somewhere around 4%. To be reviewed by the internal management committee level, so that they don't go to that breach level and then try to get out of the PC. It's ideal for companies to have a lower threshold limit to review frequently on a quarterly or monthly basis, so that you are well within the norms, on the breach, without breaching it.
They will act as a preventive deterrent.
Yes. Because once you go into the PC, it's very difficult, and it will have a lot of impact in terms of your rating, in terms of your ability to raise funds. And again, RBI says that you will have to be there 4 quarters consecutively, to after you comply with the norms. Yeah, go ahead.
Well, the PCA framework would increase the monitoring and have, even with a significantly small size of portfolio, the NBFCs would come under the ambit of the regulations, and it would ultimately give comfort to the investors and the stakeholders. And of course, as mentioned, if the risk management committee already has lower thresholds, then it will give all the more comfort to the stakeholders in terms of the triggers that the different triggers for separate thresholds, for separate ratios that we just discussed. The threshold, this is a summary of the actions that need to be undertaken in case when the NBFC gets into the PCA framework. If it triggers threshold 1, then there will be a restriction on dividend distribution. Promoters and shareholders will be asked to infuse their capital and reduce the overall leverage. There will be restriction on the guarantees, and this is only for the CICs. But again, I believe even for other companies also, which are not CICs, guarantees or any external liability, any additional liability is what the RBI would not want the NBFC to undertake in case it is in a PCA. For risk threshold 2, in addition to the actions stated in threshold 1, the NBFC will not be able to expand its branches, given the fact that any branch expansion would need additional funds and monitoring. So the threshold, in case the threshold 2 is breached, the NBFC will not be able to open up new branches. Third threshold, which is the most critical, wherein all the ratios are completely off the track. In addition to the actions taken in case of threshold 1 and 2, 2 additional actions will be taken by the NBFC. One is appropriate restriction on the capital expenditure will be put. So other than the technological upgradation, the company will not be able to make any further capital expenditure. And technological upgradation also has been provided only with the view that it will somewhere indirectly help in increasing the revenue. So only to the extent it increases revenue, the capital expenditure can be done, and no other further expenditure in terms of acquisition of, say, plant or machinery or office assets cannot be undertaken. There will be a reduction in variable operating cost. So there will be a restriction in the variable operating cost. Again, since the variable cost forms a major part of any NBFC or any company rather, the RBI will closely monitor the operating costs as well of the NBFCs which fall in the third threshold. Discretionary actions, it may or may not be taken for irrespective of the threshold in which the NBFC falls in. It can be strategy related, governance, capital, credit risk, market risk, HR related, profitability. These can be taken. This is as per discretion. Of course, once RBI intervenes, it will be determined on case-to-case basis whether whether restrictions related to these aspects are to be covered or not, or to be imposed on the NBFC or not. Moving to the next, as we all know, digital lending norms came. There has been a lot of discussion on this point since years, more so during the COVID, when the loan service providers and the apps, digital lending apps, just flooded the entire market. So on 2nd September, the official guidelines for the digital lending norms was issued, and NBFCs were given time of 3 months to implement them. Timeline of till 30th November was given, a time of 3 months was given. Of course, since it was in discussion since long, so NBFC somewhere knew that they would, and they were making themselves ready to sort of make arrangements to adhere to these guidelines. Before the guidelines came, of course, the master directions and the other outsourcing norms and related activities, related restrictions were already there in the master directions, but this being specific, we have just called out a few points which were earlier not there, may or may not be there, but they were not in the master directions. But now with the digital lending, the specific circular clearly spells out the definition of the digital lending app, digital lending platform, digital lending. Then loan servicing. Another major aspect, major change in this has been that the regulated entities, that is the NBFCs, which are undertaking their digital transactions. Any transaction has to be executed by the borrower through the NBFC's bank account. So earlier, there were a lot of third-party lenders, third-party loan service providers, fintechs to say, were added, were there in the loop or were in the picture of digital lending. And they somewhere used to assist the small-sized NBFCs to say that, let us, let us become a part of the lending, and then just collect the disbursement from the lenders and then pass it on to the NBFC. And there were a lot of issues involved in that. So that has been removed. No fee or charge can be imposed by the loan service provider directly. If any fee needs to be charged, it has to be done by the NBFC directly. Grievance redressal officer again cannot say that I am responsible only for the NBFC, but any third party app or service provider that is there in the ambit that the NBFC is using, grievance redressal officer also needs to ensure the complaints arising from those channels as well. Privacy policy needs to be put up. Then with respect to direct selling agents and direct marketing agents and recovery agents, timeline has been specifically mentioned that they cannot persistently call the borrowers before 8 a.m. and after 7 p.m. for recovery of loans. Then the probable impact, of course, it had a huge impact. As we all know, with the digital lending norms, a lot of small players have been affected. Major ones, if we can say that with these definitions now, the scope of bypassing the law has been slightly reduced. LSP, since it cannot charge directly from the borrower, so the incentive that they used to carry, that they used to have, that also gets reduced with this, and ultimately it affects the cost of loan to the borrower. FLDG, as we all know, it has been in discussion since quite a while. There is still clarity that needs to be, the industry is still awaiting clarity on the FLDG norms, which will have a huge impact on the fintech and the NBFC partnerships currently and in future as well. Another change, microfinance loans, as we all know, in July last year, RBI came up with the consolidated set of microfinance loans, which again has been in discussion since quite a while. So just to sum up, it just gives a level playing field to the NBFCs and who used to give the microfinance loans, but due to lack of any we can say standardized norms, they used to take advantage of their own leverage to give low cost funds to the same borrower for which MFIs were already in place. So certain restrictions in terms of disclosures and policies only has been included. And there is no cap on interest rate. One major change in terms of microfinance loans. There's no cap on interest rate, unlike the earlier extant regulations wherein the MFIs were capped by there was a 10% and a 12% capping based on the asset size that they had. That has been removed completely. So now all the players, be it a bank or an NBFC or a microfinance institution, they are free to price their loans.
Debashri, if we can wrap this up.
Just the last securitization norms, one major change. Loans with maturity of less than 365 days cannot be securitized. So this ultimately means that small size loans, which most of the fintech players provide in terms of buy now pay later services, a 10-day, a 1-day, or a 12-day loan, or a 14-day loan. So that cannot be securitized now. So this somewhere impacts the even quantum of the loans, of such loans that may be given, because earlier the NBFCs knew that in worst case they can get them securitized, but now it cannot happen. So this was the last. So I wrap up with this.
Thank you, Debashri, and my name is wrongly appearing there. No problem. I think thanks for your drill presentation. So we have a lot of queries and less time in hand. So I'll wrap it up quickly. Shan, Shan, we have received a lot of queries on the PBC.
Yeah, I tried to answer. I think 44 questions are there. 13 I tried to answer.
I was seeing that you were continuously replying. So with respect to PBC, we also receive a lot of queries as to there are companies who tend to fulfill PBC for 1 or 2 years, and but they don't intend to carry on such business. So what should be the real consideration if we PBC? Should we go to RBI to apply for registration, or go to RBI to explain our position that we don't intend to do this, and we will be back to meeting? We will be back to not meeting the PBC in coming time, or what should be the
ideally, it is better to communicate to the RBI and take their guidance on that. Actually,
okay.
There are no crystal clear, specific, guidance in the guideline. They only talk about meeting the primary business criteria norms. The moment you are not meeting those norms, it's better to communicate to the RBI and then be guided by whatever instructions they give. Actually, and they are very approachable that way.
Okay. Another query on the registration itself is there is now for the existing NBFCs, there is a glide path for meeting the NOF of 10 crore. But for all the new NBFCs that are going for registration, RBI is seeking for NOF of 10 crores from day one. The question is, though the NOF is increased to 10 crore, but RBI takes 8 to 12 months these days to give registration. And to block this 10 crore for such a huge long period is a worry for a lot of the applicants. So should RBI work around some way where they go with 2 crores initially? If the registration is granted, then they ask you to bring money before you start the business.
That is one way of RBI not wanting many NBFCs.
Even if serious players would not like to block their capital for such a long time.
No, I understand that, but probably the RBI is also of the view that already there are more number of NBFCs. They don't want to add new NBFCs, and they have to regulate them and all that. Maybe that is one strategy they may follow. I do not know. Okay. As such, between banks and NBFCs, the regulatory arbitrage is being plugged. It will be only a matter of time, at least for middle layer and upper layer. There will not be much difference between banks and NBFCs in terms of the regulatory aspects. So having regard to all that, RBI will only grant or registrations to such kind of entities or promoter pedigree who will have the wherewithal to manage the affairs to the level of expectations which the RBI has.
Okay.
And already in RBI's view, there are a lot of NBFCs at present, which they are also not. In my view, they also find it difficult with their bandwidth to supervise, inspect, and all that. So
they have also recently, I believe there was a tender also from RBI to engage professionals to go and check the NBFC's compliance status over Pan India. So that is also something which RBI is working on. So moving along, so there is a question, Debashri, you can answer. As per section 3 of the circular, NBFC is not availing public funds and not having customer interface. The extent regulation will continue to apply till the time RBI comes out with separate regulations. Does this mean CICs and NBFCs without customer interface, additional provided in this circular will not apply?
Yeah, Devashri, we're on mute.
Can you just repeat the second part of the question once?
So does this mean CICs and NBFCs, non-deposit taking NBFCs without customer interface, additional framework in SBR will not apply?
So the restriction is only on the NBFCs which do not have customer interface. In case there is any customer interface, it can be any NBFC. The SBR would be applicable on them.
But if it is not without, it is without customer interface?
If it is without customer interface, as we discussed during the presentation, in case there is no customer interface, the RBI does not intend to sort of regulate the NBFCs to such an extent. It is intending,
or they will
right,
not be.
They will eventually be in the base layer. So a lot of restrictions would anyways be not applicable on them, like the net owned fund provision, which is such a concern in the industry. In case there is no customer interface and the company and the asset size is significantly small, RBI does not feel the need to sort of regulate these NBFCs. And as stated, different guidelines will be issued, which we are yet to receive. Okay, so once we get a clarity on that, probably a lot of existing regulations might also be removed from the ambit of of an NBFC which does not have customer interface.
Yeah, this is for you, whether applying for a new license or trying for change in management control, which is the more suitable option?
My view is that change in management control.
Still a better option.
Yeah.
Okay.
Because that has got a specified guidelines, and it might take, basis my earlier experience, it takes about 2 to 3 months for them to give the change in management control. That was for a listed company. If it is unlisted, it could be much easier actually.
Okay. When can a core investment company fall under the higher layer, Debashri?
As we discussed, the core investment company would be in the base layer. It can fall either in the middle layer or in the upper layer. So core investment company would not fall in the base layer at any time. And regarding the customer interface, what we were just discussing also, a CIC will by default be either in the middle layer or in the upper layer.
Master direction, yeah, July 2015 or 16.
So clause 3.1c states, considering the need for professional experience in managing the affairs of NBFCs, at least one of the directors shall have relevant experience of having worked in a bank or an NBFC. This requirement is applicable to all NBFCs. How to comply with the same in case of a small NBFC having no public interface and major investment in group companies and stock market? Shan, you can.
Yeah, if the company already has a director, who's managing the affairs of the NBFC, and it has been existing for a period of, for some years, maybe the company can represent to RBI stating that the incumbent already has an experience in NBFC, and thus he satisfies that one director with NBFC, experience criteria. I wouldn't say there are any hard and fast rules here. Probably the company has to represent and go by what RBI, whatever is the feedback or guidance given by RBI.
Okay.
And in scenarios like these, generally, scenarios like these, probably the companies generally go by the experience on a one-to-one basis rather than what is written in the law. I mean, in case a person does not have such substantial experience but has limited or relevant experience, maybe in a related field also at times, that also is considered.
Okay. Does a systematically important CIC also need to have a board-approved limit for exposure to capital market, Devashri?
Exposure to capital market, as we discussed, it is there in part of, it has been identified as a sensitive sector. So if the sensitive sector exposure, as we discussed, it is applicable on a certain set of norms. Sorry, which category has been asked in the question?
Systematically important CIC.
So if it is a systematically important CIC, it will either fall in the middle layer or in the upper layer. And since sensitive sector includes capital market exposure, So it will have to, follow the norms of the exposure limits, and other things will have to be defined. Board approved limits will have to be set. And what we discussed in the PPT, the sensitive sector exposure, since it is applicable on middle layer and upper layer, and CIC forming part of the middle layer and upper layer, they will have to follow with the guidelines, specific guidelines in terms of the exposure.
Right.
Okay.
Complete this.
As detailed, circular on paras 3.23b, Roman B and Roman C will be issued by the Reserve Bank in due course. In the absence of this circular, do the base layer NBFCs still have to have the approved board policy in place?
For which provision exactly?
2.3
for what?
B and C.
No, board policy for what?
Board policy for
That
which?
is not mentioned. Okay, we'll move. My questions. Shan, I think you must have encountered this. How to pay a revenue stamp duty on digitally executed DPN?
Digitally executed DPN. Honestly, no, I am not.
Okay, so we'll reply it offline. Devashi, you have any idea?
No, in fact, I think this is one of the reasons why the digital lending norms and other things have been put in place. And somewhere it was breaching a lot of traditional NBFC lending parameters. That is why the digital lending norms states has also, of course, it has not spoken about the revenue thing.
Size you check.
But in case, even if it is digital, it depends. I mean, the very purpose of making a demand promissory note was to put an obligation on the borrower. Now, in certain cases, the DPN, in digital transactions, at times companies make substitute to the DPNs. That is to say that they might have any alternative. The ultimate idea is to just put an obligation on the customer that they will pay. And just to make that document valid, a revenue stamp used to be made. Now, if it is a digital transaction, then any other revenue can be used, is what my view. So you may add to it.
I think Shan has not handled it, so we'll take this offline. This is whether the asset size of a step-down subsidiary will be consolidated with the ultimate parent company, which is also a NBFC, for calculating the asset size of rupees 1,000 crore. Devashi, you can.
I may not be able to answer this.
I think if subsidiary, I believe if subsidiary is also an NBFC, then it might be, because in a case of calculating asset size on a group basis, the asset size is determined for the purpose of NBFCs. So yes, if the step-down subsidiary is also an NBFC, then it might be considered consolidated for the purpose of
consolidated basis. On a consolidated basis, I am not able to quote the exact paragraph.
Yes, there is a. I remember there is.
It was there. I remember that.
Yes.
So there's a provision which says that to determine the amount of the total, in which layer would the NBFC fall?
Correct.
The consolidated size of all the NBFCs in that particular group needs to be added. So let's say there is one MFI, there is one CIC, and there is one, say, P2P, for example. Now, by the SBR guidelines, P2P will remain only in the base layer. Now, if the total consolidated size goes beyond 1,000 and the MFI does not have the size of 1,000, but say MFI only has 100 crores. Now, MFI, if we look at it individually, it will fall in the base layer. But because it is part of the group, that consolidated amount of which is going beyond 1,000, it will fall into the middle layer. But the applications, the regulations of the middle layer will be applicable even on the MFI, even if individually it falls in the base layer, because it is part of the group whose total asset size is more than 1,000. So despite being looked at it individually, being a part of the entire group, it will have to comply with the middle layer NBFC, with the middle layer provisions. Now P2P, as stated in the SBR, P2P will remain.
Correct.
So P2P will remain only in the base layer. So even if the group, other companies in the group are falling in the middle layer, P2V will still remain in the base layer, but the MFI will have to follow the middle layer.
Okay. So if a NBFC ICC having hazard size of less than 1,000 crores and having customer interface, will it fall into base layer?
It is by default in the base layer since it is less than 1,000.
Any change in FDI into NBFC BL ML? I don't think there is any change basis the layers in the FDI provisions.
No, as such, there is no change. 100% FDI is allowed.
So major difference between tier 1 and set 1?
Sorry?
Major difference between tier 1 capital and CET1?
CET1, they are given a separate guideline for the upper layer, wherein they have to compute based on the prescriptions given there actually.
Okay. Registration, whether registration is mandatory for base layer NBFCs, I believe every NBFC registration is mandatory if you're falling in any of the layer. I believe I have answered most of the questions. Many of them is already answered by Shan. So I believe we have done for the day. Thanks, Shan, for your spending your time and for sharing your wisdom. It's been a pleasure to have you. And thanks, Debashri, for the wonderful presentation. Thanks everyone for